We've all been assuming that as the US economy is exploding and everyone is employed and incomes are rising, the Federal Reserve has indicated they're going to start selling some of the mortgages that they own, that all of these pressures should push mortgage rates higher in 2022, and that will finally slow this superheated housing market. But it turns out that US mortgages are a global, interconnected market. And US home buyers are using much more than just mortgage rates to make purchase decisions. So suddenly this spring, factors are conspiring to make it even more competitive than last year's crazy year, if that's at all possible. But it sure seems like it is. One factor is that even as mortgage rates are a full percentage higher than they were last year at this time, inflation is still far more higher. In other words, the real rate that I am paying on my mortgage is actually negative. With a 4% mortgage in a 7% inflation environment, my real mortgage rate is negative. And home buyers know this. My mortgage gets cheaper every day. That inflation is above 4%, for example. So if I'm a buyer and I expect inflation to stay elevated for maybe several years, then suddenly that makes it very attractive to actually have a larger mortgage. Add in the Russian war in Europe, and that has the effect of adding uncertainty to the world economy. And so it's much less certain that we will keep expanding, and therefore mortgage rates drop in that environment. So at some point, this market's going to cool. And the question is, what are we going to tell our home buyers and sellers today? And how will we know what to say when the market finally does change? So that's why we're here today. Every week, Altos tracks every home for sale in the country, all the pricing, all the supply and demand. We analyze all the changes in that data, and we make it available to you before you see it in the traditional channels. Traditional real estate data is released monthly, so by the time it gets to you, it's kind of old news. I'm Mike Simonsen. I'm the CEO of Altos. I believe that we can help buyers and sellers make smart decisions even in these super crazy times. So let's take the next 50 minutes or so. We're going to dive into all the data. We're going to prepare as best we can. The first thing I'd like you to call your attention to this week is the Altos Top of Mind podcast. If you haven't yet had the chance to listen to our podcast, it's been really terrific. We're doing interviews with the best thinkers in the real estate industry to add context to the data. You know, we look at the data every week here, and we do these big webinars once a month. But the podcast interviews have been so powerful to add ability to interpret what the data is doing. These are the three most recent interviews we've done. Connor Sen is a Bloomberg columnist, and one of the things that I took away from the discussion with Connor was the global supply chain that we know, everybody knows that is the global supply chain is backed up. It's hard to get parts. It's one of the things causing inflation. But in the housing market, what's happening is we have a ton of new construction in process that is unable to be finished because, for example, garage doors aren't available, or windows or appliances. And as a result, we actually have very few new homes able to be bought and moved into today. And what Connor points out is that is therefore adding pressure to the existing sales market. If you wanted to buy, you have fewer options in new construction right now. So this is how supply chain is driving one of the other factors driving our hot housing market right now. With Dan Green from homebuyer.com, Homebuyer is a lender, a mortgage lender for first-time homebuyers. And with Dan, we talked about how rising mortgage rates actually helps increase the availability of mortgages to more people. We talked about incentives, especially all the incentives in the legislation for first-time homebuyers. So Dan gave me a masterclass on mortgages, and it was a really terrific conversation. And one of the great things that Dan did and does is Dan is a master communicator about the data. And so if you are a real estate professional and you're thinking about how do I build a relationship with my clients through content, listen to the Dan Green Top of Mind podcast. You'll get some great takeaways there. And finally, with Odetta Kushi, who is the Deputy Chief Economist for First American Financial. And with Odetta, we talked about how the dynamics of this seemingly unstoppable market are very different from the 2008. And a lot of our home buyers and sellers are still worried, and they are not taking action because they are afraid of these bubble conditions. So Odetta and I talked about how these are different, how last time was different, and this time is a much more conventional, strong, bullish housing market. So the Top of Mind podcast, by the way, we have in the chat, we have Lael and Jeff from the Altos team. So if you're using the chat, you can, when I reference things like the Top of Mind podcast, there'll be links in there that you can go click through and take action or see what I'm talking about. So you can, and they'll be, Jeff and Lael will be helping answer questions as we go along the content today. So big ideas for today. Does inventory finally start climbing? When does it start climbing? What are the conditions that we can look for? I have some data on current mortgage rates and delinquency to put that in perspective, mortgage delinquencies. Are we going to see any inventory from changing mortgage rates or changing delinquency trends? We obviously have renewed buyer competition this spring. We thought it might be cooler, but it's actually heating up. So a lot of the data is pointing out what that means. And then, of course, I try to use these conversations here to help us how we help clients through their fears right now. People are afraid to transact. They're afraid we're at the top of the market. They're afraid to miss out. Fears are all around us. So we're going to try to use that context when we look at the data. And then finally, we'd like to do some local trends. We've got a couple of really interesting stories this week to look at some of the local data. So we'll take the next 50 minutes or so. We're going to dive through all the data, through the local markets, and make sure that you use the chat for questions and for the links as we go along. Okay, let's start at inventory. We are record low available inventory of unsold single-family homes. Only 241,000 homes on the market right now in the US. And what's fascinating is we are listing 75,000 or so new homes each week, and we're selling 77,000 of those. We are each week decreasing our available inventory. And if you think in terms of months of inventory, we're actually nationally at 3 weeks of inventory. That's the sales rate, how fast all the inventory would sell at the current sales rate. Like we're at just over 3 weeks of inventory. It is remarkably low, and it's still declining. So most years, and you can see the annual trend here, the annual trend, most years inventory bottoms in January or maybe February. And then by March, each week it's ticking up to prepare us for the full spring buying and selling season. What's happening right now is that the buyer demand is increasing at a faster rate than the normal spring listing demand. And so we're still decreasing. Last year, the low point of inventory for the year was April 30th, and inventory didn't start climbing until May. We were hoping that rising rates would cool this market and cause inventory maybe to start picking up earlier than last year at this time. But so far, every week over week, we still have lower inventory. And so at this point, we'll probably hit a bottom of maybe 220,000 single family homes, 222 by end of April. It'll be fascinating to see if it turns, if April 30th is again our turning point this year. We have a forecast of how we might think about inventory in a market, in a world where we assume that mortgage rates resume their climb and stay higher for the year. Each line on this chart is a year, and you can see the normal curve. It starts curving up January, February, peak at midsummer, June 30, and then start declining for the end of the year. We get fewer listings. Finish up the purchases in the third quarter, and then a lot less in the fourth quarter. So that's the normal curve. You can see 2020 was the big pandemic year, and we just changed all the rules. I've highlighted here 2018 in the dark blue line. 2018 was the last time that we had rising mortgage rates. We went from 3.9 to 4.9. And what you can see is that 2018 started with relatively low inventory, lower than the other years, and then finished a little bit higher. So this was a move from 3.9 to 4.9%. It slowed the market a little bit. It allowed for a few more listings and a few fewer buyers, and that let inventory build. If you were a seller at that time, you actually could feel, if you tried to sell, say, in September or October of 2018, you could actually feel the slowdown. Ultimately, you sold because it wasn't that big a deal, and that's really the key here. If you have buyers and sellers worried about, or maybe waiting for inventory because rates are going to rise, we can show 2018 inventory rose a little bit, but not significantly. So that's the dark blue line here, and you can see how it climbed just a little bit. Last year is the light red line, and we were already at record low. We had a little bit of more normal seasonality than 2020. So we got back to our normal seasonal curve. And now we're in the dark red line at the very bottom. The solid's where we've been. The dotted is how we can imagine the forecast for the rest of the year. In an environment where rates rise and we do add a little bit, then you can see how that would back end load a little bit of inventory for the end of the year. And maybe we end the year at, say, 350,000 instead of just 310. Maybe that gives us a little more. What's interesting is the comparison between this year and 2018. In 2018, by mid-March, inventory was already rising week over week. We were already in our normal cycle, and now we're not there. So at the most, what this tells us is at the most that inventory increases are going to be very back-end loaded. And it really tells us that probably 2023, before there's any chance of significant slowdown, even marginal slowdown in this market, because it's got to take several months for inventory to build. And inventory building just from 310 to 350 is still going to be essentially record low levels. So, and it's multiple years before it could get anywhere back to historical norms. And so what that tells us is that the 2022, the price gains, the tight inventory, the buyer demand is already pretty much baked into the data for the year. And so it's unlikely to see any real slowdown. And so, while what we could see, you might have seen especially around December time, forecasts by different companies for the year. 2021 was a super strong year. Therefore, you have a reversion to mean, back to normal. Maybe 2022 is going to be a 5% home price increase year. But really, we can already see we're at 12, maybe it's another 15% home price gain year, because the dynamics are you can't turn the battleship quick enough. So that's what we're looking at for the forecast. This model assumes that rates resume their rise. They spiked in January and February, but they've actually ticked down. And so that assumes they resume their rise. It assumes things like the war in Russia doesn't impact the economy, the world economy, too dramatically. In fact, so this is in interest rates over time, and interest rates over time. Each color here is a year. You can see that the blue and orange section up here, that's 2018. The orange section is 2018, and rates rose up, peaked at the end of 2018. And so that's the time that we're comparing to. I mentioned Connor Sen, who is the Bloomberg columnist on our Top of Mind podcast. And Connor pointed out that there are enough global factors of bond buyers who will likely keep mortgage rates under 4.5%. So Connor's forecast is that mortgage rates will have a hard time getting above 4.5% in this global macro market. I'm not a mortgage rate. I'm not an interest rate forecaster. So this was Connor's take, and it's a really compelling argument. What it says to us, though, is that it will be, if rates can get up there and can help slow this market a little bit, it will be really hard for rates to slam the brakes on this market. The other thing to point out in this is the real interest rates. So with inflation at 6-7% and the 30-year mortgage rate at 3.7, that difference means my mortgage gets cheaper by that much every year, as long as inflation is in that place. And so if a buyer has expectations that their expectations are that inflation is going to stay elevated for multiple years, that helps that buyer to make a buying decision now, maybe in the bidding war, that says, you know what, it's because I, the buyer, believe that mortgage rates are going, or that inflation is going to stay high. That means it is actually a better deal for me to have that more in a mortgage now, and it allows me to make a competitive offer in a competitive market. It's something to think about, and it's an opportunity to ask the question of your buyers: where do you expect inflation to be in the next few years? Help them think about in those terms. But until, if and when rates finally climb, it's probably 4.5 or 4 above that, closer to 5, before we can really measure that impact that adds to a little bit of supply. At this point, our inventory forecast still accounts for that. One place we always want to look for potential inventory is in the distressed mortgage market. And if you have to sell your house because you are unable to pay your mortgage, then that becomes opportunity. The foreclosure process is finally emerging from the pandemic restrictions. And so there are more foreclosures happening. These are typically, the ones that are in the foreclosure pipeline right now are typically properties that were already delinquent, already in the process pre-pandemic 2 years ago. And now it's legally the time to put those through to actually complete the foreclosure process. So some of those are coming to market. Don't be fooled by the headlines, though, that say 7 times more foreclosures happening right now, because what's really happening is that we are in this record few numbers of people who are delinquent on their mortgage. So the record few people are behind on payments, and that is because when your home is gaining in equity and your mortgage rate is locked super low, it's a really good deal to keep paying your mortgage, and people figure out how to keep paying their mortgage. Or if they can't, They sell, and they sell their home in 7 days, and they don't have to go delinquent. They don't have to hit their credit. They don't have to go into that foreclosure process, and they can take their cash. So as a result, the delinquency, the numbers of homes, the percentage of people who are delinquent in any stage of delinquent on their mortgage is falling every month, and is already past the previous lows. It's at multi-decade lows, and it's still falling. And what's interesting in this number is this is from CoreLogic, and the most recent announcement is December. Well, we already know that January, February, and March, in terms of the housing market, are way hotter. So you already know that by the time they announce their March number in May or June, that's going to be even lower record few people in delinquency. And that is why there's no inventory possible to come from this state, a traditional source of inventory. So you can already see, and so as I pointed out, why we can already see that 2022 is baked into the data, even if there were some catastrophic event that forced more Americans to start selling their homes, or maybe forced them to not be able to pay their mortgage and go into a delinquent state. Even in that world, we are looking at the second half of the year at the earliest before that starts trickling in, and really 2023. So 2022 has really got all the data baked in already. Okay, let's go to prices. The median home price in the US, single family home, this week is $394,500. We are only a few weeks into what is the normal spring increase in home prices. It peaks. We have through April, May, June, and probably into July this year before home prices plateau for the summer. The dark red line here is you can see that starting to climb up. Pre-pandemic, home prices were at 319. You can see that tiny little dip was the 3 weeks of pandemic adjustment. By week 5, home prices were back and resuming their climb. So that we had 3 weeks and 3 down weeks. And so what we're looking at now is probably sometime in the next couple of weeks, the median home price will cross $400,000, and that'll be the highest, the first time ever median home price in the US over $400,000. That'll happen sometime in the next few weeks. The light red line here is the price of the newly listed cohort. Each week, new homes come to market, they get listed. And when we track the prices of those, it tells us where the whole market is going to be in a month, because they get listed now, more get listed next week. And after about a month, now those are the active market. Then they get offers, then they close, and then that gets recorded. So the light red line is our leading indicator for the prices for the whole market. And that this week is at 399. And there's a psychological barrier at 400,000. So if I can list it 399 and get some bids and have it sold at 410, or if I list it 409, I may list at 399. And so we will see a barrier. And so that it'll plateau a little bit, right, at 400,000. And you can see in 2017 here, June through July of 27, or January through July of 2017, the dark red line, see it plateaus all summer long. And actually in 2016, there was a plateau at 250, I think it was probably 249, and then at 299 the following year. You can see those plateaus in each summer. And so we'll probably have a little bit of plateau over there before we cross 400,000. But all of the leading indicators here are about increasing prices, right? They at some point will go past that barrier, and then there'll be the next psychological barrier will be 449 or something like that. The other leading indicator that we like to pay our attention to are the percentage of homes on the market with price reductions. And if you'll remember, about a third, 30, 35% nationally, will take a price cut in normal markets. That's a rule of thumb. So sometimes that's accidental, sometimes that is a strategic, sometimes that's a overly aggressive seller. There's a lot of reasons, but about a third. And then they don't get their offers and they cut their price before they sell. You can see that then in hot markets, some of those do get their offer. And so then only maybe 20% need to take a price cut, and right now it's only 17% need to take a price cut. So a third think they're overpriced, but only 17% have had to take a price cut because some of those guys are getting their offers. We can look here. What I want to compare, I've got the dark blue line for 2018. So in 2018, we have rising rates, and you can see the dark blue line started pretty low, hot market beginning of 2018. And then as rates rose through the year, price reductions ticked up and then grew to the highest that we'd seen it in these last 6-7 years. So what that tells us is that is what we can expect in a rising rates environment. 37, so we were at 33 or 35% is normal. So you could see 37% felt cool at that time. It felt like things, if you were selling, you could feel it. So then what happens this year? The light red line is last year. And you could see that in the third quarter, we actually had some cooling. We had markets like Boise that had been super hot or, mid-pandemic that cooled off. And we had some more price. We got back to a more normal set of price reductions. None of it was high. None of it ever cooled off into a cold market or a cooling market, but you could feel it slow down a little bit. So as of right now, in 2022, we are right on pace from last year, as hot, if not hotter than last year. And so what we'll see is we'll have to see price reductions hitting a floor and then start ticking back up. And that will allow inventory to build. That means that I overpriced, I didn't get my multiple offers, the house sticks on the market for a week or two, and those things happen. And so, but we've got several more weeks of that before, really probably April 30th, before we start getting that back up. If rates rise significantly, we could see that slope steep, and you can take it there. But like I said, we are well into 2023 before you would see any real signs of cooling. So that's how you can look at price reductions. You can look at this in your local market too. And when I show you the local market reports, you can use this to judge. Your local market may be more commonly higher or lower than 30, than that third range. Places like Phoenix tend to be more like 40 or 45% normal. There's a lot of investors. There's a lot of inbound immigration buyers in Phoenix. So that tends to be have more price reductions more commonly. In a lot of the hot California markets where inventory is chronically restricted, it's much more common to be only 20% with price reductions. So they are now, we can use that as our local adjustment. But when I say 35%, I'm talking about a national rule of thumb. This is our immediate sales tracker. The immediate sales are the phenomenon where the home gets listed and it takes offers within hours or maybe a couple of days of listing and is sold, before the weekend. And there's always been immediate sales. There's a lot of places where there's hot markets and you get homes that sell quickly, but it's really been a phenomenon in the last, post-pandemic, super low interest rates, the demographic trends. We have all of the confluence of the hot market, and you can really measure it in the immediate sales. So this week of 75,000 or so new listings, 23,000 of them went into contract essentially immediately. It's a across the country phenomenon. You can see slight differences local places. Some of for example, Miami markets might have fewer of those, but it's across the country. And so in order for inventory to build, Inventory is really, this is the dark red line here are each week are the listings that didn't sell immediately. And so we need to see those climbing each week. And what we've been seeing is really the percentage of that are immediate have actually been growing. And so the absolute number of the percentage has been growing. So it's like a third of the market is going immediately. I've been looking for this, hoping that this shrinks a little bit, because this is where it shows us overheated. It shows us bad for buyers. It shows us a bad experience for a lot of the participants. And so it makes it harder for price discovery because people are just bidding. So a seller doesn't actually know what their house is worth. So like we want to see fewer immediate sales really to have a healthier market. And hopefully we will see that start to slow, but there's been no signs of it slowing yet. So each week, keep your eye on the immediate sales to see if rising rates, for example, or maybe other macro factors have been allowed us to cool off at all. Let's switch to price increases. Price increases are the percentage of homes on the market that have taken a price increase. Very commonly, these are flips, investor flips. Maybe it's iBuyers, people who that bought the homes, they put a little bit in and have relisted it at a higher price. Currently, we're at 5.6% of homes that are on the market at a higher price. It's actually a little bit lower than last year. Last year, we were still surprised. And so we were surprised there were people who took their homes off the market over the holidays, and then we were all, wow, the market like is crazy hot. And so then they came back on and relisted in January, February, March. And so we were at 7% or 7.7% at the peak last year before it started ticking down. Again, if this is really high, normally it's like 3% or maybe 4%. And so you can see I've highlighted here 2018. This is when we had the rising rates. And so then at the beginning of 2019, we were only 3% of the market that was on with price increases. So those are fix and flips. People put money in. And so it was, but still 3% of the market. It's not zero where, when the bubble's bursting, that's down to zero because nobody can put it back on at a higher price. There's no flips happening. So we're currently at 5.6. If this gets too high, that's one of the signs of speculation, of fraud potential. And those are the signs that get scary around things like a bubble bursting. Because we don't have we have a lot of investor buyers, but we don't have, and we haven't seen much evidence of like fraud, mortgage fraud, things like that happening. That's one of the signals that says these are organic buyers that are likely to continue their momentum and not have at this stage any signs of like a big bubble bursting out from under us in the market. Let's look at market time. So median days on market, we have a normal annual cycle. Each vertical line here is a week. And you can see that normally this time of year, 2.5 months, 80 days on the market maybe, but falling because we get faster inventory, we get more buyers in March, April, May. And then by June, now we have things that if they didn't sell at the beginning of the year, that now they're sitting around and we have the 4th of July holiday, and then we start getting closer to school. And so the market time starts ticking up in the second half of the year. We have this very clear cycle every year. You can see I've highlighted normally at the peak of the season might be 50 days, a little over, a little under 2 months. This is nationally. Lots of markets would be faster, many would be slower, different price points. This is all price points. So, so very often the high end of the market may take a lot longer to sell. And we can look at that in some of the local data as well. But 50 days peak market. Pre-pandemic, right this time, right before the pandemic hit, 2 years ago, we were at 84 days. It was a normal market time there, actually pretty quick. But then you can see we have this little stretch up here of bump right after the pre-pandemic. That was when the first lockdown happened. And then we started dropping. So last year at this time, we were at 55 days. So last year, this time we were already sort of at peak season, but it kept falling down to all the way down to 20 days. And now we're only 35 days. So 35 days on the market, median across all price points, all the single family homes across the US active market right now. Basically what's happened is we've taken all of the long listings, either overpriced or the wacky places, or they're on busy streets, or the things that normally take longer to sell. Those sell in hot markets. And in fact, if you're working with potential buyers, right, or potential sellers right now, one thing to point out is that the hot market is the time to sell your weird property, the stuff that's normally really hard to sell. It's a good time to sell those properties. If you're working with buyers, that one caution might be that don't be tempted to buy the really weird ones, because the really weird ones are hard to sell unless you're in a hot market. It's something to think about for your buyers and sellers right now. But you can see it in the market time. So we're currently 35 days, falling very rapidly. I'll show you where, we'll probably be, under a month by next week. I can show you the price points where that happens. And then we'll probably be fascinating to see, do we get under 3 weeks by like lower than last year by April, May, June. We'll see if that happens this year. Here's the price ranges. So at Altos, we do every market, every zip code, every city, state in price range quartiles. The high end of the market may be behaving differently from the low end of the market. You can see this market segments on every Altos report. These are the market segments for the national view for all the homes in the country right now. High end of the market is 1,000,001. Low end of the market is 135K. These are homes that you can see they're old, 71 years. You can see that they are on small lots. A lot of these are in like the Rust Belt cities. And you can see that where they come from. And what we can also see here is in the far right side of this chart here, days on market in the middle, $300,000 to $500,000 price ranges. They're lower, 28 days. They're still a little bit higher at the very high end and at the very low end of the market. So by next week, though, it'll probably be at 28 days across the board, because the other two will drop. The two outliers will drop too. The technique here is that a seller may be thinking that they're at 28 days, but really they're pricing at the high end of the market, or they're pricing at the low end of the market. And you would say, so in your price range, this is what's happening. You may see a buyer in a crazy hot market, maybe tempted to, like an investor, maybe tempted to go for this low end, $100,000 price range. And maybe tempted to buy, but it allows us to point out to them that when the market's not that hot, those are going to take much longer to sell. And you can see it in the price range, the market segment right here. It's always very valuable to make sure that you're connecting your buyers and sellers with their price point in their local market. By the way, if you haven't already, you should grab the Altos Market Data eBook. And what we do there is we teach you how to describe the way I am describing the data here, how to use the scripts, where to point out the market segments, how to talk about days on market, any of those elements. So if you haven't already downloaded, I encourage you to go to the link. I'm sure they'll post the link in the chat for the Altos ebook. Download the ebook to learn how to use market data to build your business. Really valuable for all the participants along the way. We try to show how to especially some of the more interesting ones, the the price reductions and some of the other ones that are less common that you might not be familiar with. So get the ebook. Let's look at a couple more stats and then we'll switch over and look at a little bit of local data and then we'll wrap up. Market Action Index for the US right now is 300, is at 61. This is a scale 0 to 100, 30's balance. 30, below 30 are buyer's conditions. That means inventory is built and buyers are slowing, and therefore the buyers, that speedometer will go down to the 30 mark. Below 30, buyer's conditions can be associated with falling prices, stable or falling prices over time. But right now we're in strong seller's conditions. It's across the country, and it's increasing. You can see it's ticked up. The little gray to red is actually increasing over last week. And I'll show you how to read that in your local market reports as well as the national one. This is what the Market Action Index looks like over time. And the light red here is the weekly reading, and it's a little noisier, but it allows you could see the pandemic where things cooled off. And then in 2021, when things were skyrocketing, surprisingly strong last year. We hit a peak at 65 mid-summer last year, and we're already at 61 right now. We're likely on the way to a new record high this summer. And you can imagine inventory is super tight, demand is super high. You can see all of those factors. So it'll take time. Of inventory has to climb significantly to bring us back down. We haven't been nationally in a buyer's market for like a decade. We've had, because rates have been low, the economy's been expanding, because we've had a lot of investors buying homes and owning homes, and individual investors as well as like big companies, mostly individual investors buying one or two homes. Those, because all of that and inventory has been shrinking, we've been in seller's market conditions for many years. So it'll take us many years to actually get back to anything cooler. But normally you might be more balanced, and we just haven't been balanced since the pandemic at all. So that's the trend over multiple years. You can see we're not quite to last year's record high, but we are on our way. All right, I'm going to switch to some local data. I had a conversation this week with Raj Kassar, who is the CEO of the Boutique Real Estate Group in Orange County, California. And Raj was he had a buyer for a home in Yorba Linda and was trying to communicate to the buyer what the competition was going to look like, how they needed to structure their offer, and why it might make sense for them to bid what feels like shockingly high numbers. In Yorba Linda, so this is Orange County, we can see the Market Action Index is at 90. It's up from last month, so it's getting hotter right now. We can see that over here we have the percentage of homes on the market with price decreases is normally 30%, and in Yorba Linda, it's 0 right now. We can see that inventory, 17 homes. If I look at the big chart here of inventory, 3 years of chart, normally 120, 100, 120, maybe 150 homes, and we are at 17 homes. We're at 80, 90% fewer homes available right now in Yorba Linda. So if you want to live there, and especially if you're in a world where you believe that inflation is high and is going to stay high, you can imagine that having a little more in your mortgage allows you to overbid, beats your competition in the bid, because your payment is a little more, but as the rates are still super low, that payment doesn't adjust very much by your overbid. And real rates, because inflation is high, means that next year you're paying with cheaper money. So for that buyer, it made sense, and Raj's buyer got the house, had 40 competitive offers. We can see in Yorba Linda, the lowest stuff at $1 million. Everything is 7 days. It is hyper competitive. There's only a few homes on the market. But that's what Raj was able to do with his buyer who is on the fence. Raj puts the Your Build report in their hands and allows them to use the data to make an intelligent offer and get the home they wanted to buy. I had on Twitter this week, there was some speculation we saw of people thinking, are Russians in the US selling homes to capitalize on their cash, maybe extract their cash? Sunny Isles, Florida is one town where there happens to be a lot of Russian investment. I was talking with Inez Garcia, and she mentioned that they have 200 agents in that office in Sunny Isles. And so the question was, in Twitter, it was, oh, the Russians are running. And so are the Russians running? So we looked up Sunny Isles and we'll see what we see. So these are condos. We were looking at condos in Sunny Isles, a lot more condos there. So I thought I'd pull that data up. So the seller's market, but increasing. So getting warmer this spring. And let's look at the inventory. Is there inventory? Are there a bunch of Russians suddenly selling? So here's 3 years of inventory, 1,400 condos, 1,500, and we're down to 552. So even if there are a few Russians maybe selling, what we can see is nobody, there's nothing in the data to verify the claim that a bunch of Russians were selling homes suddenly in South Florida. We're in the same conditions that we are everywhere else. Tight inventory, falling inventory this spring. You can see some of those condos are very expensive, $5 million, and they might take 6 months to sell. But anything under $1 million is going pretty quickly, and you can see exactly where what you're buying in that part of beautiful Miami. I just have the Miami report for overall up, and just to say, bigger, this is the whole Miami metro. This is inventory over the last few years there. A tiny little bit of inventory increase over the last week, but we're still at record low. It still nothing's climbing yet, but we can keep our eye on this to understand if the market's changing. We can also see in the price range quartiles exactly where the demand is. This is single family homes in the Miami region. You can see that $500,000, $600,000 range, where over the super expensive ones taking a little bit longer to sell. Price reductions, only 14% in Miami. Price increases is 8% because it's more of an investor market. And so there may be fix and flips happening, but not super high, but still pretty high on that side of the market. Just do a couple more. This phenomenon, our strong sellers market increasing this spring, not decreasing like we'd been hoping. This is a trend across price points across the country. So here's Des Moines, Iowa. You can see we're at 63, strong sellers market up from last month. So it actually decreasing demand, increasing supply. We can look, here's our multi-year trend of inventory in Des Moines at our record low. We can look at price decreases in Des Moines. So last spring we were down normally 40, 50. This is normally 40, 50%. We'll take a price cut. Last spring we were down at 25. We're about the same, a little bit higher there right now, but not yet to peak Des Moines, which is going to be May. And we'll see that happen, what happens in the next few weeks. And then Phoenix, I thought I would do a quick check on Phoenix. Phoenix is interesting because Phoenix is what I call a high beta market. Beta in the stock market terms is a stock that is more volatile than the market as a whole. So a high beta stock, when the market goes up, will go up more. Phoenix is a high beta market in real estate. So When it's hotter than everybody. When it's cooler, it cools faster. And here's one way you can see the beta, the measure of volatility in Phoenix. You can see here's pre-pandemic. We had 2 more weeks of market up. And then when the lockdown happened, Phoenix adjusted down very quickly. There's a lot of sellers in Phoenix who said, or a lot of owners in Phoenix who said, I'm not getting stuck like I was in 2006. And so there was real strong price adjustment, 475 to 400 in just a few weeks. That, though, changed back very rapidly. So that came back, like the rest of the country, came back very rapidly. So in Phoenix, we had 1, 2, 3, 4, 5 weeks before the market turned around very quickly. Median home price in Phoenix is now over 500,000 and is going to tick up this year. You can see everything moving quickly in Phoenix because the market's hot, and therefore Phoenix is hotter than most. Okay, that is our local data for the week. As a reminder, you can get the ebook. If you're at this point and you say, oh, Mike, can we hit my local market? The answer is yes. Go to altosresearch.com right now, book time with our team. We will look at your local market. We'll talk about the scripts about how you look at the data for your local market, for how to help them understand, your buyers understand about this competitive bidding environment, and help your sellers plan appropriately. Is now the right time to sell? Is it going to burst? Do we need to get out now before? Like, all of those questions you can answer with the data, help all of those fears. So I encourage you right now to go to altosresearch.com. Our team is here waiting for you. We'll stick around for just a couple more minutes and make sure we got all the questions in the Q&A. Thank you so much for attending. Check out the Top of Mind podcast, and we will see you next Monday for some more data. Thanks, everybody.